So we go to still in the trading profit and loss account. We're done with that's the income statement. For the income statement, we have two parts. We have the trading part, which is the trading section, where we have to get our gross profit.
Yes.
Now we need to talk about the profit and loss section of the income statement. So for the profit and loss section of the income statement, we use it to get our net profit or profit for the year. That is what we use the profit and loss section of the income statement get. So how do you get the net profit or the profit for the year? The profit for the year is the gross profit from the trading account plus any other incomes minus expenditure. You get what I mean here? So in the profit and loss section of the income statement, what we need from the trading section is the gross profit, which is cost of or sales minus cost of sales. So as soon as we get our sales minus cost of sales, which gives us our gross profit, we take our gross profit down and we add all the incomes in the profit and loss section minus expenses. That's how we get our profit for the year for value. So here they said, the profit and loss section of an income statement is concerned with profits and losses, gains and expenses. Its purpose is to calculate the final profit after all running expenses and other items of income. This is known as the profit for the year. The formula for calculating the profit for the year is gross profit plus other income minus expenses, which is clear.
Yes.
So the profit and loss section of an income statement must have a heading which includes the periods of time covered by the statement. It's also usual to include the name under which the business trades. So whatever name, you can't just have items. They need names. Oh, AB loans give us a loan. We are paying loan on interest. Whatever expenditures we have, it has to come with the name of the business or the name of the company. That's what they are saying there.
Yes.
So as with the trading section of an income statement, a profit and loss section can be prepared using either the horizontal or the vertical method. Using the horizontal format, the gross profit and other incomes are shown on the credit side and the expenses are shown on the debit side. If we use it this way, we have income on the credit side and expenses on the debit side.
Like this?
Yeah, if you're using horizontal.
Yeah.
Yeah. But if it is vertical, the difference between, you just have to write the difference between the gross profit and incomes and expenditure. So in that way, you're still going to get your profit for the year. So let's go down now. So here we have the horizontal. So on the horizontal here, we have the expenses on the debit side and income on the credit side with your gross profit.
Yes.
So discount allowed is an expense. That means you gave your customer some discount, which becomes a part of your own expenditure. Wages, you are paying your workers. So it is an expenses for the business. General expenses, which can be maybe stationery, whatever expenses that you don't want to, give an account to. Maybe stationery, maybe transportation and all these ones. You can have a general expenses for them. Maybe for plumbing. So these are little expenses made by the business. So instead of having a whole account for them, you have it in your general ledger as general expenses. Then you have your property tax, loan interest. So the difference between the discount, you had discounts allowed, wages, general expenses, property tax, interest. You add them together. Then you find the difference between you had the gross profit and your discount received. You add it together.
Yes.
Then you less it from all the expenses. That gives you your profit for the year. Do you get it?
Yes, yes.
All your income, part of your income could be commission received. Maybe you receive commission. It's an income for the business. How do you receive a commission? Maybe your business sold some property that they are giving you certain amount. Like a commission comes when for example, you sold a property like a land. And they said, oh, if you are able to sell this land, we give you 10% of the value of the land. That is a commission. So it is part of your income. So you add it to your gross profit. So commission received, discount received are part of incomes that you can add to your gross profit. Then before you less it from expenses. So when you less it from the expenses, you have your profit for the year or net profit. Is it clear?
Yes. Yes.
So the profit and loss section of an income statement can also be prepared using the vertical. So either ways, this is the vertical side now. Prepare down, we're still going to get the same value. So it depends on which one you like to use. Which one is which one you're comfortable with? I think the horizontal one is better for you, right?
Yeah, the horizontal.
Okay.
Or the vertical. Yeah.
Which that is, you like it, right?
Yes, yes.
Okay. Now go down. They said the two sections of the income statement are usually presented in the form of one combined statement, which normally presented in vertical format. The profit and loss section follows on immediately after the trading section, with the words gross profit being written only once. The heading of the income statement includes the period of time covered by the statement and the name under which the business trade. So what you're saying is, okay, Samuel income statement for the year ended. And you write the date. That is what they are saying there. Is it clear? Yes. Because this is Samuel. So Samuel income statement for the year ended. I think that is clear.
Yes.
Okay. So for the income statement, notes we said it's going to be trading account, trading section. Afterwards, you have your profit and loss section. So they go, it's after each other. Yes, so your trading section ends with gross profit. Then you continue with your profit and loss section, which has the income and expenditure. Clear, right? Yes. So now, as soon as you are done with preparing the trading app, everything is done. You transfer the ledger account to the total income statement. So here you have your purchases account, your discount received account, purchases returns account, and wages account. So for our nominal ledger, we have the purchases account, which is the total of all purchases. We have our purchases, yes, which is 65,000. You see that? Yes. Then we have our total sales. The value of your purchases returns, you write it if there is any. Yes. You are transferring now. When you are transferring, what you have is the nominal ledger. So in the nominal ledger, so it's total today. What? Total today. Total today. That's the value of is at the end of the month, at the end of the year. Mm. That's the total to date. Up till when you prepare this account. So close the account. When you are closing the account. Yes. Yes. So when you are transferring from the statement of profit and loss, you are transferring into the nominal ledger. You have your purchases account. Yes. The purchases account. Remember the purchases you bought. It is a debit balance. Yes or no? Yes. So total to date will be on the debit side. Then the income statement will be on the credit side. It will be in reverse now. Mm-hmm. Your purchases account, your total of your purchases account will be on the debit side. But your income statement, which you have, will be on rating income statement on the credit side. That's the purchases. For purchases. For purchases returns, you have your total to date on the credit side, your income statement on the debit side. Do you get it? Yes, yes, yes. In our ledger, purchases is always on the debit side. Yes or no? Yes. But when we are transferring from our statement of profit and loss to our ledger, our nominal ledger, your purchases, your income statement, that income statement, the value in the income statement, yes, goes to the credit side. Your total to date, which is your normal purchases, will be on the debit side. Your income statement will be credited, your purchases will be debited. For purchases returns, where you are returning the product to the supplier, your total to date will be on the credit side. Your income statement will be on the debit side. Discount received. You know, discount received is an income, yes or no? Yes. So the income now will be debited on the income statement. It will be debit side on the income statement, and your total to date will be on the debit side. Why is it debited? The income is all yes. You receive it now. Your income statement. Normally on the statement of financial statement of the profit and loss, you have your discount received on the credit side. Yes or no? Yes. So because you have it on the credit side, it will be debited on the debit side in your nominal ledger. Yes, I get it. Do you get it? It's the opposite. It's the opposite. Then your discounts, we don't have discount allowed anyway. So our wages account. Your wages is on the debit side. Right? Yes, and now the income statement will be on the credit side. And the wages account will be credited. Yeah, your wages account will be credited. Will be credited. Yes. Your income statement will be debited. No, your income statement will be credited. Also. Wages account. Remember, expenses is on the debit side. Wages is on the debit side. Yes, yes. Income is on the credit side. Yes. So your income now, when it is discount received, it will be income statement on the credit side. On the debit side here. Discount received is an income. is on the credit side of your statement of profit and loss. Yes or no?
Yes, yes.
When you are preparing it, when you are transferring on your ledger in the discount received account, it will be on the debit side because it's on the credit side there. Discount received plus gross profit.
Yes.
Now, wages is expenses. Wages is on the debit side of your statement of profit and loss. Yes or no? So because it's on the debit side there, your total to date will be on the credit side. For your total to date will be on the debit side.
Yeah, total to date, yeah.
On the debit side.
Yes, yes.
And your income statement, your wages account on the income statement will be on the credit side.
Yes, that's what I said, that wages account, income statement will be in credit, and wages
Income
account,
statement will be credit.
statement will be debit.
Total to date will be on the debit side.
Yes.
Because wages is expenses on the debit side in your statement of profit and loss.
Yes.
Okay, you want to? So there are two entries for the inventory in the income statement. The inventory at the start of the year, which is the opening inventory, and the inventory at the end of the year, which is the closing inventory. The inventory account will have a debit balance representing the inventory at the start of the year. So your opening inventory will have a debit balance. Your closing inventory will have a credit balance. The stocks you have, like you're starting the business with, it's going to have an opening balance.
Yes.
So your ledger, look at the ledger here. The nominal ledger for the inventory account.
Yes.
The balance brought down, that's the amount, which is 7,100, I think, the opening inventory. From the beginning of the year,
yes,
your opening inventory, you have it at 7,100. That's the balance brought down.
Brought down from the last year.
Yeah.
Yeah.
At the this year.
Carried down from the last year.
Carried down from the last year now becomes brought down here. Yes. So that's 7,001. Then the income statement will be 7,100. Now, the income statement here, how is it 600? Yeah, they said we have 500. Hold on, please. Go back up here. In your ledger, look at your closing inventory here. Where? We have our closing inventory in the statement of profit and loss. Go back, please. In the statement of profit and loss, our closing inventory is 7,600.
Yes.
So that's our
closing the inventory.
Yes, that's 7,600.
That's 500 more.
The opening, June 1.
Yes.
27. That's the opening inventory.
7,100.
7,100.
Yes.
Now, we have the inventory account has to be the same on one account, which is the opening and the closing.
Yes.
The opening has to close, or the opening, which is the balance brought down, 7,001. That is what we are. That's what we closed with the last year that we are opening with now. That's our opening, which is the balance brought down 7,001. The income statement we have 7,001. Now, for 28 that we are closing, the income statement will be 7,006. Then the balance brought down will be 7,006 for next year.
7,006.
Yeah, for June 28. This is May 31. That's the end of the financial year. Yeah. Then June 1, 28, we have our balance brought down, which will be our opening inventory. This year is over on the 31st of May. We closed this year on the 31st of May with 7,600 inventory. For June 1, 28, we're going to open our inventory with 7,600.
Yes, yes, yes.
Do you get it?
Yes.
So look at what they said. They said the entry of 7,600 on the debit side represented the inventory at the end of the financial year on 31 May 28 becomes the opening inventory for the year beginning 1 June 28. Is it clear now?
Yes, yes.
So a profit for the year represents a return on the owner's investment. So the profit we get after gross profit has been added to income less expenses. That profit that is made is the return on investment for the owner. So that is the money we made after paying all our expenses, paying our taxes, paying our interest. So what is left is the profit of the owner. So to be transferred to the statement of financial position. So A loss for the year will, now they said, this will appear in the debit entry in the income statement and should be transferred to the credit of the capital account as it represents, as it increases the amount of the business owes the owner. A loss for the year will appear as a credit entry in the income statement and should be transferred to the debit of the capital account as it reduces the amount the business owner, the business owes the owner. So if you make profits, it is transferred to the statement of financial position. You add it up with your capital, which adds up to the amount of money the owner of the business, the business is owing the owner of the business. Because the business will still continue to use the money. It becomes the retained profit. So the owner of the business continues to use the money, which means the business is owing the owner more money because it's the profit of the owner of the business. But if you are making a loss, you transfer it to the credit side of the capital account. Do you get what I'm saying here? If you make a profit, look at the last sentence before we go. They said a profit for the year represents the return on the owner's investment. This will appear, are you there?
Yes.
This will appear as a debit entry in the income statement and should be transferred to the credit of the capital account. You have your capital account. What does your capital account mean? That the capital account represents the value, the amount of money the owner of the business gave to the business.
Yes.
So under your capital account, you're going to have balance brought down for that amount the owner of the business has given the business. You get what I'm saying here?
Yes, yes.
They said it will transfer to the credit of the capital account. This is your capital account. For your capital account, you have the debit side and the credit side.
Yes.
Profits made will be added to the balance brought down. Balance brought down on the credit side, plus profits.
Yes.
That is clear. But if you are making a loss, it has to be on the debit side of your capital account.
The balance brought down.
No, the balance brought down stays here.
Stays in the credit.
But the capital stays on the other side. Then you have to take it away from the balance. That remain, whatever remains here is the amount that the business is owing the owner of the business. Because the owner of the business bears the loss.
Yes.
The owner of the business takes all the profit, yes or no?
Yes, yes.
So because you take all the profits, when there's loss, you take all the losses. So the business continues to run.
Yes,
but it's going to be on the debit side, stating that, oh, your balance has been deducted from what loss we have.
So the balance will be on the credit side and the debit side will be the capital.
Capital is always on the credit side.
Always on the credit side.
Yeah, it's on the credit side because it's the balance. That's what the business has given.
Yes.
Now, when you make profit, you add it to the balance. Balance go down. Balance represents the amount of money the owner of the business gave to the business. Profit is added to it. Now, capital plus profit is the total the business is owing the owner of the business. But if the business is making a loss, the capital stays.
Yes.
But you take the loss from the capital. So you have your balance carried down here. So the balance carried down is what the owner of the business is needs to get from the business, or what the business is owing the owner of the business. Do you get it or not?
Yes, yes.
Should I draw it out or you get it?
No, I get it. Yeah.
So that is what they said. They said the credit balance on, okay, now they said, as explained in chapter 2, the total drawings account. So look at the capital account. Okay, we have it down here. Look at the capital account. The balance brought down. That is the amount of the money the owner of the business gives to the business. You add profits because you made profit of 13,900. Yes. So the total is 103,900. This is the amount the owner of the business has to get from the business. Do you get what I'm saying?
Yes, yes, yes. Sorry, I haven't. No, cool.
Can we continue?
Yes. No.
Okay.
Yeah.
So for our capital account, thanks. For our capital account, we said on the debit side contains loss or drawings. On the credit side of our capital account, it entails the balance, which is the amount of money the owner of the business has given to the business and the profit made by the business. Do you get it?
Yes, yes.
So that's how we prepare our balance. That's how we prepare our capital account. So at the end of it all, you take away the drawings. If the owner of the business has taken maybe, okay, here they said the business took 9,300 as drawings. So drawings minus the total on the credit side will give you your balance carry down. So your balance carry down is 94,600.
Yes.
So this is the amount that the business will pay Samir.
So that's the amount that
the business is owing Samir.
that's the profit of Samir. Because he's the owner.
Capital. We don't call it profit anymore. Because it has been added up to the capital.
Ah, yeah.
Additional capital.
Yes, sir.
Is it clear? Is it clear, please?
Yes, it is.
All right. So the drawings account. For your drawings account, how do you prepare your drawings account? You have drawings already.
Yes.
For how much? 9,300. Remember, drawings is on the credit side. Remember, drawings is on the credit side on your capital account. So if you are preparing the drawings account now, the drawings account is given out. Drawings have to be the capital, the amount now will be on the credit side. You won't write drawings anymore. You write capital.
Yes.
Because it's part of the capital that has been withdrawn. So on the credit side of your drawings account, you have capital for 9,300. Then, if there's there was a cash taken, 9,000, and the purchases from stock of 300. They said goods were taken for personal use by the owner, 300. 900 for cash. That is how we got our 9,300. You only do the drawing account is just the analysis of how the owner of the business has taken whatever it takes for own use for the business. So it's not going to be like, oh, 9,300. How did he take cash of 9,300? No, the owner of the business took cash of 9,000 and goods of 300. Because the goods the owner of the business took will be recorded as purchases.
Yes.
Do you understand?
Yes, yes.
So if you don't make the analysis this way, there will be problem in your purchases account because your purchases account will be having 300 extra. So where is it from? It is written here. So 9,000 was cash. Huh?
300 less.
Of the 300 less. Yes. 9,000 for cash and 300 for goods. So that's how we got our 9,300. I think it's clear.
Yes.
As soon as this is done, we now prepare. Now they said, okay, income statement of a service business. For a service business, it's different from a normal business. For service business, we're talking about maybe insurance company, banks. They do services. Their income statement is always different from the income statement of businesses that sell goods. Yes. Businesses that sell goods have carriage inward, carriage outward. But services is not like that. Like schools, like educational industry. What are they carrying? Nothing. Do you understand?
Yes.
They have customers, but their customers are not buying goods. They are buying services. So their income statement will be different from the income statement of businesses that trade in goods and in goods. Clear?
Yes. So
we go. The income statement of a service business. A service business is one which does not buy and sell goods, such as an accountant, an insurance company, a travel agent, hairdresser, and so on. At the end of the financial year, these businesses still need to prepare a financial statement. However, the trading account section of the income statement is not prepared as no goods are bought and sold. Only the profit and loss section of the income statement and the statement of financial position are prepared. So, for a service business, it only prepares profit and loss account. It does not prepare trading profit and loss. It does not have trading. It does not trade. Trade means buying and selling of goods. Here it's about service. So it is income and expenditure. Do you get what I'm saying here?
Yes, sir.
For a service business, it only have income and expenses. So there's going to be carriage outward. Maybe, let's see anyway. So here we have, they say Anita is a business consultant. She provided the following information at the end of her financial year: property tax, general expenses, insurance, printing, loan interest, wages, rent receivable, commission received. Prepare the income statement for Anita for the year ended. So with what we have, property tax is an expenses. It stays on the debit side. General expenses debit side, insurance, debit side, printing and stationery, debit side, interest, debit side, wages, debit side, rent, receivable, income on the credit side, commission receivable, income on the credit side. So the difference between these income and expenditures gives us our net profit. You have it here. Is it clear?
Yes.
You have it there, right?
Yes, sir.
All right. So that's our net profit. Then with that, we are done. So, okay, you have exam start question. Do you understand the difference with what we did now?
Can you
repeat it again? Yes, I will. I will.
Commission received. What's this?
I will. In your income statement for a service business, like I told you earlier, for a service business, they don't buy, they render services.
Mm-hmm.
So if they render services, it's possible they have commissions. So for example, I'm an insurance company. You have an insurance, let's say you have an insurance company. I work in your insurance company. So as an employee of your company, you tell me that, oh, make sure you sell motor insurance, like at least sell $10,000 worth of motor insurance for our clients. We'll give you 10% of it. You know, insurance companies, they sell insurance, right?
Yes, sir.
So if I'm able to make a target of $10,000 of motor insurance for the company for this year, I receive commission. 1,000. Do you understand?
Yes,
so that is commission received in my own account.
Yes, yes.
Do you get it? Yeah. But in this account, it will be commission payable. Yes or no? It will be commission payable for this account if there is any. Mm. Are you getting it?
Yes, yes.
So for this business of Anita is a business too, right?
Yes.
It does business with other businesses. Maybe Anita sells property. So as soon as Anita sells the property she sold will be, there's a commission for it. So the commission is commission received.
For her, but the other company will be commission payable. Yeah.
So for Anita's business, it will be commission received. Is it an income or expenses?
It's an income.
It's an income. Mm. So that is why we are having this. So in a service business, we don't have trades, we have commissions. So based on what we have here, we have property tax. So look back to the items. Property tax is an expenses. It's a tax. It's an expenses. It will be on the debit side. General expenses and expenses, you add it to it. Insurance is an expenses, you add it to it. Printing and stationery is an expenses, you add it to it. Interest on loan is an expenses, you add it to it. Yes. Wages to your employees is an expenses, you add it to it. Rent receivable. Maybe Anita with the premises, Anita gave part of the premises to somebody or to a business, that the business has to pay Anita some rent. Mm. That is rent receivable. It is an income for Anita.
Yes.
But if Anita has to pay her own rent, it is rent payable. It's an expenses. It will be on the debit side there. The commissions receivable, or commissions received. It's an income for Anita. It's on the debit side, on the credit side. So rent receivable, commission received are income for Anita. It will be added together. Then you take it away from Anita's expenses. That gives Anita's profit for the year. Mm. Is it clear now?
Yes.
Okay. So we have the questions.
Yes.
How is the cost of sales calculated? Cost of sales. Opening inventory plus purchases minus carriage inward? No. Opening inventory plus purchases minus carriage. It's not minus carriage. It has to be added to carriage inward. So let's check C and D, right?
Yes, sir.
So opening inventory plus purchases plus carriage inward, yes. Minus purchases minus closing inventory. So the answer is C. Clear, right?
Yes.
Question B. Question 2. At the end of the first year of trading, Rashid provided the following information. Revenue will be. So revenue, we have purchases. So do it this way.
Sales.
Purchases, we need to get the gross profit, right?
Yes.
And gross profit is cost of sales minus cost of sales.
Yes.
So what is our cost of sales? Purchases, 49,700. Please add it together. 49,700.
Yes.
Plus carriage inward, 1,150.
Plus.
Less closing inventory, 4,800.
Carriage inward less.
No. Purchases, 49,700.
Yes.
Plus carriage inwards.
Yes, inward.
1,150.
Yes.
Minus closing inventory.
Which is
49,700. 4,800.
4,000.
800.
So it's 46,000 minus the 72.
Yeah,
plus
46,000 minus 72,500.
minus 72.
1,500.
26,440. 26,450.
450, yes. So the answer is C.
Okay, what about carriage output?
Carriage output is that it's part of your profit and loss.
Oh yeah. After you finish the gross profit, you're gonna
Yeah, so they put it there to convince you. When you take whatever you do with carriage outward, you will see an answer here. What is wrong? Because carried outward is not part of your trading account. It's part of your profit and loss account.
Yes, yes.
Clear, right?
Yes.
So question 3. May a fashion retailer did not record goods costing 500 taken for personal use.
Good. Yeah.
You see, it did not record goods taken for personal use, which is a drawing, yes or no?
Yes.
You are supposed to deduct it from your purchases.
Yes.
Isn't it? But you did not deduct it from your purchases. So what happens to your gross profit?
The gross profit will so I have to deduct it. So
if you
stated.
You are supposed to take it away from your purchases, right?
Yes.
But you did not. So what happens to your gross profit?
Gross profit will be understated. Or not overstated.
Overstated.
Because
you're supposed to take away something, you did not take it away. Yes. So gross profit will be overstated.
Yes.
And what happens to your profit for the year?
It will be overstated. Or under. Wait, it will be
listen. When you take away your personal goods for personal use, when you take it away,
yes,
your gross profit will be normal. But when it's going to be overstated. But your profit for the year, because you are having an overstated profit for the year. Remember, at the end of you are having an overstated gross profit.
Yes, yes.
So what happens to your profit for the year?
We understated. So you overstated because it's overstated in the gross profit.
No, it means your gross profit is more now.
Yeah.
If your gross profit is more, when you less expenses, it will still be more.
Yes, yes.
So your gross profit will be overstated, and your net profit will be overstated.
Yes,
A. Question 4. Oh, let's see. The question is
correct.
Prepare is no. That's going to take a long time. So we stop there, right?
Yes.